Gold is falling again, and that is exactly what those in power want you to focus on. Behind the charts, governments and central banks are quietly taking control of the world's last form of true collateral. Every price dip distracts from the real story. Gold is being weaponized in a silent war for trust and control. The price tells you nothing, but the accumulation, well, that tells you everything. For months, the world has been fixated on the gold price, watching it rise to record highs and then retreating just far enough for commentators to announce the end of the story. This is the usual mistake that traders and journalists make when they treat the chart as the only tale to be told. But the price of gold may well be down from its all-time highs, but the meaning of it has rarely been greater. What actually matters is not the number on the screen, but the movement beneath it, because the world has entered a new kind of conflict. This is the new gold war, and it is not being fought over the usual means of territory or trade, but instead over trust itself. In this war, the battle lines are not drawn with tanks or tariffs, but with vaults, reserves, and policy statements. The more the financial system bends under the pressure of politics, the more gold becomes the collateral of choice in a world that no longer believes its own promises. Nations are no longer hoarding gold for tradition or nostalgia, and instead they're hoarding it for independence. And investors, in turn, are beginning to realize that the recent weakness in the gold price is a distraction rather than the signal. The United States perhaps offers the most visible stage for this first act of the conflict. Washington's institutions, perhaps once considered the gold standard of governance, now behave more like factions of a permanent campaign. Central banks and courts have become political footballs. Investors see the same spectacle that citizens do, and they understand its implications. When the rule of law becomes conditional, so does the value of the money it supports. The dollar remains the world's dominant currency, but its moral authority has weakened. A moral authority is the foundation on which every fiat system rests. This is why governments are behaving like investors and investors like governments. They are diversifying their reserves and asking questions that were once dismissed as paranoia. Where is the gold held? Who controls access to it? What happens if a political dispute turns into a financial one? The answers are now shaping policy from Washington to New Delhi. In India, the Reserve Bank has quietly repatriated much of its bullion, shifting storage from London to domestic vaults. Officially, this is a technical measure, a logistical matter. In reality, it's very much a declaration that trust has become jurisdictional. India has no intention of surrendering control of its reserves to anyone else's courts. The lesson from Russia's frozen foreign exchange assets was received loud and clear across the global south. Ownership without possession is merely faith, and faith is no longer a credible policy tool. China's behaviour tells the same story on a larger scale. The People's Bank of China continues to accumulate gold month after month, even as it talks about digital currencies and innovation. It has built new infrastructure in the form of the Shanghai Gold Exchange and regional vaulting capacity that give Beijing more control over settlement and custody. These are not decorative gestures. They are mechanisms of monetary sovereignty. They have been built in anticipation of a world where access to liquidity might be conditional on political loyalty. And meanwhile, in Russia, ordinary households have joined the movement from paper to metal. Citizens are buying gold as a substitute for a currency that they can no longer trust, turning the act of saving into an act of resistance. When money fails to perform its social contract, people reach for something that does not need permission to exist. And all of this is happening while the price of gold has softened. After touching record highs well above $4,000 per ounce, it now trades below. News outlets cite an overbought market and blame profit-taking, and now Jerome Powell, the Federal Reserve Chair, has reminded markets that interest rate policy is not on a preset course and that a December cut is far from a foregone conclusion. The imagery he chose was telling. When you drive in the fog, you slow down. It was a neat way to admit uncertainty while sounding prudent. Now, markets reacted by trimming expectations of further rate cuts, and gold dipped slightly on the news. Before Powell spoke, traders saw a 90% chance of another cut this year. Afterward, the odds fell to 60%. Yet the story behind those numbers is far more important than the movement itself. What Powell revealed without intending to, was that even the central bank no longer feels it can see the road ahead. The data is incomplete because of a government shutdown, and the policy debate within the Fed is fragmented. This is not confidence. It is caution disguised as control. And of course, the gold market understood this, even if the price didn't reflect it. When the most powerful central bank in the world says it is driving through fog, investors should not mistake a pause in price for a change in destination, because the short-term decline in gold is a function of traders trying to read the Fed's intentions, but the long-term trajectory is a reflection of something deeper. Falling real interest rates, elevated inflation, and the visible erosion of institutional discipline continues to support the fundamental case for holding gold. What the market is witnessing is not a reversal of trend, but a test of patience. If the world were calm, the gold price might matter more. But in a world where politics has invaded every corner of policy, the real story is the repricing of trust. Gold has become the collateral of credibility, the one asset that is no one else's liability. The post-war order rested on a hierarchy of trust led by the United States, reinforced by the predictability of its legal and financial systems. But that hierarchy, that's dissolving. Is replaced by a patchwork of regional arrangements where each bloc prefers assets it can control directly. Now, the West treats this as an inconvenience, and the rest of the world sees it as if it were a financial liberation. By holding more of their gold domestically, countries reduce exposure to sanctions and signal a shift toward monetary self-determination. Even allies of Washington are adapting. Central banks continue to increase their gold holdings, often at the expense of US treasuries. This should not be seen as a protest, i.e. something which will be reversed once demands are met. Rather, you should see it for what it is. It's insurance against the politicization of finance. Now, of course, it is tempting to look for official confirmation that gold has been remonetized or elevated to new regulatory status. The internet is full of claims that Basel III has reclassified gold as a Tier 1 HQLA, effectively turning it into cash for banks. This is wishful thinking. There has been no such change. The reality is more interesting than the rumours. Gold is regaining its central role, not because of a bureaucratic rule change, but because the logic of the system itself demands it. When political risk becomes financial risk, the only safe collateral is something that cannot be cancelled, censored, or redefined by decree. Now, the obsession with the daily price obscures what is really happening. Gold's recent decline has coincided with a period of extraordinary demand from central banks. They are not buying because they expect a rally next week. They are buying because they expect instability for years. The short-term movements of the price are noise generated by traders trying to front-run the Federal Reserve. The long-term accumulation by sovereigns is the signal that the financial architecture is being rebuilt around something tangible. Veteran investors like Ray Dalio call gold foundational money for good reason. It is the benchmark against which all other forms of wealth must eventually be measured. The interest rate cycle can change direction. Currencies can rise and fall, but gold remains the test of truth. When debt exceeds income and when politics replaces discipline, the only reliable benchmark left is the one that governments cannot print. Investors should recognize the pattern. When nations question the rules of the system, individuals should too. The arguments that justify national repatriation apply equally to private wealth. Custody matters, jurisdiction matters, control matters. The debate about whether to hold gold through paper contracts or physical allocation is a question of sovereignty. For private investors, the logic of the new gold war is straightforward. If governments are acting like central banks and central banks are acting like survivalists, well, then individuals should at least consider acting like both. The modern financial system is efficient, but it is fragile. It relies on digital promises, jurisdictional faith, and regulatory control. None of those can be guaranteed in a crisis. Physical ownership of gold compresses the chain of trust into something visible and verifiable. This is not an argument for isolation or for retreating from modern finance. It is an argument for proportion. A well-structured portfolio should contain a portion of assets that are outside the system it is designed to hedge. And that is the definition of prudence. Gold fulfills that function perfectly because it represents the continuity of value through the discontinuity of regimes. The new gold war is reshaping the architecture of global finance. Nations are rebuilding systems of payment and settlement that reflect their political alliances. China's expansion of its gold trading infrastructure, India's repatriation, Russia's domestic market, and the Gulf's exploration of commodity-linked currencies are all steps in the same direction. The outcome is not a single replacement for the dollar, but a mosaic of alternatives. They are all resting on the same foundation of physical collateral. For Western investors, this may feel distant, but the implications, they are immediate. The more fragmented the system becomes, the higher the premium on assets that bridge the divides. Gold is the one form of money that remains universally acceptable precisely because it belongs to no one. The lesson is simple, though it will take time for the market to absorb it. Price is not the story. Trust is. Dip in gold is the mirror image of a deeper rise in political risk. Governments are accumulating it. Central banks are moving it home. And individuals who understand the direction of travel are quietly doing the same. They need to hold allocated gold in a safe jurisdiction that they trust. The fight for trust will define the next decade of finance, and gold is its measure. Those who look only at the chart, they will miss the plot. Those who look through the noise will recognize that gold's temporary weakness is the price of permanent strength. If central banks are preparing for the fog ahead by slowing down, investors would be wise to prepare by just holding on. The world's governments are already acting. Individuals have the same opportunity to reclaim control of their own collateral. The new gold war has very much begun, and the wisest strategy is not to trade it, but to own it. If you want to find out more how to own it and hold it in an allocated, safe jurisdiction, then why not get in touch with us and click on the link below to book a free strategy call today.